So let's start with our the point where we stopped last week. So can you tell me what did we finish in the last lecture? So we will move on accordingly.
I think we are learning full disclosure principle.
Okay. So we finished full disclosure. So we finished two principles. One is revenue recognitions and full disclosure, right?
Yes.
Okay. So we will continue with our third principle, which is matching principle. All right. Okay, so let's continue. So today we will finish topic 1 and then we will start topic 2 right away, because topic 2 is more about calculation stuff. So whatever you have done in topic 1, especially your principles, especially your elements, your operating guidelines, that will help you to understand topic 2, which is calculations part. So we're still on topic 1, which is introduction to financial accounting. And we are discussing about operating guidelines. And in operating guideline, thing that we are discussing is principle. Principles. So in principles, we already finished done revenue recognitions. And second one was full disclosure. Full disclosure that we already finished. Now let's continue today's lecture with our next principle, which is matching principle. Matching principle. So before we start, let me send you the link in case you don't have. So here is your topic 1, part 2. And today is part 3. So here is part 3. So this is the last part. And of course, introduction is the longest topic in your financial accounting, right? Sorry, part C, not B. Parts 3, sorry. Part 3. Okay, so now let's start with the matching principle. Now, what is matching principle? So as you can see, matching means match, compare, all right? So what this matching principle says about? Before I start explaining you what is matching principle, let me give you one example. So in this example, I just need to know, what do you think about calculating profit? When we calculate profit, what will be the profit? All right. So let me write down here. So example. For example, you produce 300 products, right? And the cost of each product, for example, $10 per unit, all right, per product. So cost is $10 per unit or per product, right? And after you produced, you sell. For example, you sell 200 products, and the price of each product, let's say $12 per unit, right? And you know that this is your cost here, that's your cost, and that's your sales. And you know that sales minus cost is profit or loss, right? Can you calculate how much is the profit or loss? Can you do that for me and give me the answer? If you think it's a loss, calculate and give me the number.
Minus 600.
So you said 600 loss. Okay. Anybody else? Profit or loss? Same number, different number? Loss. Another person said loss. How much is loss? If you calculate loss? $600. Anybody who think it's a profit? Here is a profit. Nobody thinks profit? Okay. 600 loss. Anybody else? Different loss or profit? Nobody. Unfortunately, you all are wrong. That is matching principle. So what is the right number? So obviously this is wrong. So the right number is, we calculate sales. Sales is 200 products multiplied by $12 each product. So total sales is 2,400, right? 2,400. Now cost. All of you or most of you calculated cost 300 multiplied by 10, which is 3,000, right? That's why you got 600 loss, but it's wrong. Why? According to matching principles, your cost units must be equal or match to the sales units. And that's fair. If you match these units to calculate the total profit or loss, this is fair way. This is unfair if you calculating cost for 100 units and you calculating sales of 90 units or sales of 110 units. This is unfair because you are not matching right amounts of units. By that reason, your profit cannot be accurate. So here, your cost could be 200 units. So as I mentioned, it must be match. Units must be matched, not price or not the cost, not the money. And the cost is 10. So 2,000. So 400 is profit, not loss. All right. Let me explain you in another word. If you not agree with me, you say, oh no, this never happened. Why are you doing that? Oh, we never calculate this and that. In real life, we do that. If in real life you calculate 600 loss, you are wrong. You are completely wrong. All the businesses, all the shops they are running, they all apply matching principles to they all apply this way, matching principles to calculate your profit or loss all the time. Now, this kind of matching principles, I can explain you in another word that why matching principle makes sense. Why not like as you calculate loss, it's makes sense. This is matching principles, right? And something you calculate before that was 2,400 and 3,000. So which means 600, right? If you apply matching principle, this is matching principle. In this matching principle, what is the profit per unit? Can you tell me how much is profit per product under this way? Can you tell me? Can you calculate and tell me profit per product? How much is a profit? Like as sales per product per unit is 12. Cost per unit is 10. So how much is a profit per unit? Profit per unit is 2. That's right. So profit per unit is 2. So that's why 2 multiplied by 200 is 400. Right? Okay. Now, can you tell me how much is profit or loss per unit here? How much? Can you calculate and tell me? 600 is the loss, right? 600 is the loss. So how much is loss per unit? Can you calculate? Tell me, how much is the loss per unit? 3. Loss per unit is 3. So $3 per unit. And you multiply by what? Multiply by 200. Why not 300? Why not multiply by 300? Why are you multiplying by 200? So we don't know. We don't know. Either we should multiply by 200 or we should multiply by 300 because these units are not same. That's why these units must be same. These two units, which is cost unit or whatever, sales unit, it must be equal. So we can calculate right amount of profit or loss. That is the meaning of matching principle. So this is wrong way to estimate your profit. So always remember from now onwards, accounting or real life or finance, whenever we calculate profit, we always calculate profit following matching principles. Any business in the world, any small business, big business, small company, big company, they apply matching principles to estimate the profit within the period. Remember that. Did you understand matching principle?
Yes.
Okay.
Yes.
Now, I have one more question for you. You can see that we use sales 200. We produce 300, sales 200. It means company manufacture 300 units, but we sell only 200, right? So 300 minus 200, 100 left. 100 is left. Where is 100? Where are you going to record this 100? What is 100? Whatever is left, what do you call it? What you call this 100?
Closing inventory.
Closing inventory. And how much is the value of closing inventory? 100 multiplied by 10, because the cost per unit is 10. So $1,000 is your closing inventory. Closing inventory. Remember that. That's the actually meaning of closing inventory. Produce 300, sold 200. 100 is left at the end of the day, at the end of the period, at the end of the month, at the end of the year, depends how we calculate profit. So whatever is left at the end of the period, that's called closing inventory. And this closing inventory belongs to your current assets, balance sheet. And this is income statement. All right, so I mean, sales minus cost is your, of course, income statement that we also studied in the previous lecture. All right, so this is the matching principle. Matching principle is not about closing inventory, of course not. Matching principle is about estimating the accurate profit, the right way to estimate profit. But of course, we need to understand, we need to think about some other things that's left, because we are calculating cost using 200 units, but obviously the question could be, where is 100 units gone? It doesn't go anywhere. It just moved to the balance sheet because we haven't sold it. We will sold it next time, next day. For example, if you're calculating profit every day at night, so when we close down our business or our shop, then this 100 units, 100 inventory left, and next in the morning we start selling with this 100. All right, that's the meaning of matching principle. Understand matching principle?
Yes.
Okay. Anybody has any question or we move on?
Move on.
Okay, so let's move on to next, which is assumption. So principles are finished. Now let's move on to the second operating guideline, which is assumption. Now let's start with the assumption. So the first assumption is a monetary unit. The first assumption is a monetary unit assumption, or we call it money measurement assumptions. Now, what these assumptions means? According to this assumption, only those items will be recorded in your accounts which has money value. All right. Something has a money value, that item will be recorded in your accounts. Something do not have money value, we do not record. Something we can measure into money. Money value means something we can measure into money. For example, material. The company purchase material. Does material has money value? Yes, it has money value. So it must be recorded how much material we bought and how much material we left. Company purchase any assets, sell any assets, it has a money value. Company sell product, company sell shares, company borrow money from bank, that's also have money value. Company paid salary to their workers, it has money value. All right, but in those workers, how many males and how many females? Company paying a salary, for example, company paid salary to their employees. For example, company is paying $10,000 salary to their employees. So these are employees. All right. These are employees. Company paying them $10,000 salary to their employee. So salary is according to money measurement, salary must be recorded. How much is salary, which is your expense, right? In these employees, how many are males and how many are female? Do you think this information is a money measurement, is a money related or monetary related? Of course not. According to financial accounting, remember, according to financial accounting, not according to management accounting, maybe this information is useful for management accounting to reduce the cost or some other factors. But according to financial accounting, in this salary, how much money we pay to our male workers and how much money we pay to our female workers, that's not monetary unit assumptions. That do not meet the monetary unit assumptions, because people, it doesn't matter male or female, company paying them money. So company must record money. Company must not record the name of person in their financial account, or in that person, how many are old, how many are young, how many are black, how many are white, how many are men, and how many are women. It doesn't matter, right? So that's the meaning of monetary unit assumptions. All right. So anything which has a money value must be recorded. Money value means something we can measure in money, that must be recorded, and something we cannot measure into money. Emotions, angers, behaviors, we cannot measure into money according to financial accounting. Motivated, demotivated, people are motivated, demotivated, they like to work, they don't like to work with each others. According to financial accounting, that information, not money measurement, but for management accounting, it's maybe useful. For financial accounting, no. So we are studying financial accounting. So something we cannot measure into money will not be recorded, never record. All right. Is that okay? Is it understood? Is that fine? A monetary units assumption?
Yes.
Can you give me some example about monetary unit?
Monetary units means anything which has money value. Whatever company do, and that do means that action is an economic action, economic events. For example, you go out in the evening, for example, you go for a walk. You go for a walk, and on the way, you were walking or you go to park, you're feeling thirsty. So you go to the shop and you purchase a water, right? And then you drink water and you come home. Next day, you again go to park, but that day you don't feel thirsty. So you didn't buy any water. So you just go to park, you hang around in a park, you didn't spend any money, and you come back. So we have information about you for 2 days. One day, you go to park. This is your event. This is your activity, right? Second day, you also go to park. That's also your activity or events. But first day, when you go to park, you spend money. That's called economic events, economic activity. And that's money measurement, because you spend money, you purchase water, and water has money. I mean, you spend money for water, and water has a money value, right? So this is called economic events. But next day you go to park, you hang around, you just come back. Maybe you look people, you meet with people, you talk to people, but this talking or meeting has any connection with the money? Did you exchange money? When you talk to people, did you pay them money to talk, or they pay you money to talk to you? Of course not. So this is called non-monetary action or non-monetary units. So means company do various things. Like as I give example, company do various things. When company do various things, something affect money, maybe in or out, and something do not affect money. All right, something we cannot calculate in money. Like as you talk to people, you spend time with people, can you calculate this thing in money? No, of course not, right? But you go to the supermarket and you purchase something, then yes, it's affect in money. So monetary units means company purchase assets. Is it monetary units? Yes. Borrow money from bank, monetary units? Yes. Produce product, monetary units? Yes. Sell product, monetary units? Yes. Because all these kind of items and things you can estimate in form of money. But behavior, emotion, relation, right? Actions, not monetary related actions, that doesn't have money value. All right, something doesn't have money value, that the example I gave you before, you don't have to record, because that information is not useful. Not useful for external users. Remember, external users, because for management accounting, of course, that's important. But these operating guidelines for financial accounting, not for management accounting. All right. So now is that okay? Monetary units?
Yes.
Okay, so let's move on to the next assumptions. Next assumption is a business entity assumption. Business entity assumption. Now, what is business entity assumptions? According to business entity assumption, company, this is company, and this is the owner of company. All right. Company and the owner of company, they are not same. They are different from each other. That is business entity. They are not same. They are different from each other. Now, what does it mean? They are different from each other. It means company income and expense is not owner income and expense. Company income and expense is not owner income and expense. Let me give you another example. For example, you are the owner of company. Yesterday, you went out with your friends and family and you spend, let's say, $100 for dinner. All right? Next day, you comes to company and you record dinner expense $100 in company accounts. Can you do that? Can you do that? Can you record this $100 in your company as a expense?
No.
Of course not, because this is your personal expense, is not a company expense. That's the meaning of owner expense is not company expense. Same thing, owner personal income. Owner is making his personal income and company has an electricity bill. So that electricity bill will be paid from company income or will be paid from the owner personal pocket. Of course, that expense must be paid from company income because we spend this electricity for company production purpose, for company purpose. This is not electricity bill of owner house. If owner, he has his personal electricity bills, his house, whatever is using in his house, that's not a company expense. That's the idea here. That's why business and the owner of business, they are separate according to company. All right, according to company, not according to sole trading business. Sole trading business is a different type of business that you study in your another subject, right? But according to financial accounting, in a company, owner and company, they are different. So owner of company cannot use company assets for personal purpose because the purpose to purchase company asset is a business purpose, not a personal purpose. That's why business and the owner of business, they are separate. Did you understand that? Is that okay?
Yes.
Okay, so let's move on to the third and the last assumption. So let's continue our assumptions with the next point, which is a time period or timely period assumptions.
Mắt tiểu dạy đi vệ sinh.
Next is time period assumption. Now, what is time period assumption? According to time period assumptions, company must present informations to users in timely manner. What does it mean? In simple language, company must provide informations to user time to time. Why? Why time to time? Because you know that information has a life. Information has a life. Information has a value, and that value depends upon the time of information. If information received to you on time or before time, it may have a high value. But if you get information after events has occurred, means information is old, that information will be useless. It seems like as relevant and reliable. All right, I think it's like it's relevant. But the thing is that company must provide informations to users on time to time. But as you know, when company prepare financial statement, company prepare financial statement for 1 year. All right, always remember, company prepare financial statement for 1 year. So whatever has been occurred in this 1 year, company record and company communicate, or company present that information to the users. But if you think practically, that company is giving you information after 1 year, do you think the information that you receive from company after a year, that information has a high quality, high value? Of course not, because market is changing time to time. So we must have a latest information. If we are waiting too long to get information, means if the users are waiting too long, which is 1 year, to receive information from company, when they receive information from company, that information do not have any economic value or do not have any value that users can use it to make a decision. That's why company must communicate or present information to user time to time. So time to time means normally quarterly. So quarter means 3 months. After 3 months, company announce its profit loss, means company announce its financial information to the users. And then second quarter, and then next 3 months, then next 3 months, and next 3 months. So company providing informations on users on timely basis. So every quarter. So once company provided all quarter information, when company prepare financial statement, company combine all these quarter informations in one financial report for 12 months. 12 months. It's exactly like as you study in university. You study semester by semester. At the end of the semester, you go for exam, you sit for exam, you get result, and university give you transcripts. And then second semester, transcript, third semester, fourth semester, so on. When you finish your studies for 3 to 4 years, for your bachelor, master, whatever, then company combine all the grades and company give you final results. Company not gonna let you wait. You study first semester and company asks you to wait 3 years, and after 3 years we will give you result. No, you need information time to time. If your grades are low or you have some problems in your previous subject or exams, then you can improve next time, right? So exactly same thing happened here. So that's the meaning of time period. So a company must communicate with the users of financial information on time. So it means quarterly, first quarter, second quarter, third quarter, fourth quarter. And company combine these fourth quarter results in one annual report. So another name of financial statement is annual report. So yearly report, right? So that is time period. Is that okay, time period? Business entity definition is business and the owner of business, they are different. If you want, I can write down here. So business entity definition is owner and business are different from each other or are not same. They are not same. Now, what does it mean, not same? Owner income, owner expense is not business income, business expense. Same thing, business income, business expense is not owner income and owner expense. So they are not same, or they are different from each other. You can say that. And they should not be treated as the same in a company. Remember, company, not sole trading business or other kinds of business. Company, where company sells stocks and so on. Right? Can we move on to the next assumption?
Yes, please.
Okay, so next assumption is a going concern assumption. So going concern assumption. So what is going concern assumptions? In order to understand going concern assumptions, I need to give you examples. So, but let me write down what is going concern assumption. Going concern assumption assume that business, we assume that business will be going on in future. All right. So is that okay? Going concern assumptions. Is that fine? Can we move on to next?
Yes.
Okay, so assumptions finished. So we study 4 types of assumptions. Business entity, money measurement, time period, and going concern. All right, so we study 4 types of assumptions. So now let's move on to the next, which is constraint. Now, constraint. What is the meaning of constraint? So as I explained you before, the meaning of constraint means where you can make small changes in your accounting standard as far as it does not reduce the qualitative characteristics of financial information. So constraint means we can change in our accounting standard. AS means accounting standard, as long as it maintains the qualitative characteristic of company. Right. So means we don't have to follow accounting standards strictly, every single thing strictly. It is quite flexible to use it. Now let me give you the example to understand qualitative, to understand the constraint. So in constraint, we have the first is materiality, right? Materiality is the first constraint. So materiality. Materiality. Yes, materiality. Now, what is materiality means? So in order to understand materiality, let me give you one example here. For example, let's say your sales is 5,000, so 59,789 point let's say 70, and cost is, let's say, 49,788 point, so 89 point 30, right? So how much is profit? Profit is 10,040 cents, right? That is your profit. Another example. Let's say your sales is sales per unit, let's say $1.60, right? And the cost, that's your cost here. And the cost is, for example, $1.20. No, sorry, 20 cents only, not $1.20. We can make some changes here. Let's write $2. So here $1.20, right? And we have profit here. Profit is $1.40. Now, Look at this example A, and this is example B. If you see that here, profit is 10,040 cents. Can you tell me, if I change this 10,040 cents to only 10,000, do you think I write 10,000? I remove this 40 cents. So I write 10,000. If I change this number 10,040 cents to only 10,000, do you think it will affect users a lot? They lose their investment, they make wrong decision about investment, and so on.
No.
No, of course not. Can you call it, if company is writing instead of 10,040 cents, if company writing 10,000, do you think this is unfair?
No.
Of course not. Because why? Because this dollar amount is insignificant, very small, insignificant number. Let's take the same example here. Company profit is $1.40. Can I write here $1 only? Can I remove this 40 cents here?
No.
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 Why? Because in comparatively, this number is a significant, right? And this number is insignificant. So that's what accounting standard gives you freedom. That's the meaning of, if we can change as long as it's maintained the qualitative characteristics of company, which is relevant, reliable, true, false, whatever, right? So if you want to make changes in your profit from intentionally 10,040 cents to 10,000, that's fine. You can do that, because you know that if you're going to make changes, these changes do not affect the user's decisions. However, if you want to make some changes and that changes give the significant impact on the user's decision making, as you can see, if you reduce this one, so you can see that 40% in your profit, it will be reduced. 40% profit will be reduced. So no, you can no 40%. So 0.40 divided by 1.40. So how many percent is it? 0.40 divided by 4. So it's gonna be like 30%. 30% here. Here 30% profit will be reduced. You can calculate number here. So 40 divided by 10,000. So it's the here is gonna be 0.0004%. You can see that this is 0.004%, and here is only 0.0004%, and it is 30%. So you can do that, no problem, because it's a very insignificant number. But here, it's a significant number. So we shouldn't do that. That depends upon us. That's the meaning of materiality. So this is material. Material means significant. We cannot change it, but here we can. So materiality, exactly the example. What is the definition? I think this is the same explanation for materiality. In materiality, you have a kind of freedom to record whatever information you like it. So is it okay? Constraint? So let's move on to the next constraint. So next constraint is a conservatism conservatism constraint. So next is conservatism constraint. According to conservatism constraint, future income is not present income, but future expense could be present expense. Now, what does it mean? For example, your tuition fee. Can you pay your tuition fee in advance? Can you pay your tuition fee in advance? Yes. So if you are paying your tuition fee in advance, that is your future expense. Advance means future expense. And you are paying it now. That's the meaning of future expense could be present expense. But future income could be present income. Any kinds of income, you haven't earned it. Can you record as an income? No. You cannot record as an income that income you haven't earned it. You have not earned it. You won't call it income, you call it liability. Right? The example I gave you last time. Or I think the example I gave you, revenue recognitions, or I don't know, maybe when I explain you about the current liability, I explain you income received in advance. The income you are receiving in advance, that's not your present income. That belongs to your future services that you are transferring. In simple language, this conservatism constraint we can understand by taking example that why we save money. Why we save money? We save money for future expense. Right? We save for future expense. Why don't we think if in future we have an expense, we also have a future income? So that's why do not save now. Do we think that? No, never. Because we know that future is uncertain. So whatever expenses you are paying now for future, that will give you benefits in future. That's basically you are securing or you're saving your future. If you are paying for future or if you're saving for future. But if you are not paying for future or saving for future, that may not give you security, your future security. In fact, it's maximizing the risk in future that company also believe in. So that's why any kinds of income company hasn't earned it. Company do not record as an income. Same example. All right. But any kinds of expense that may belongs to future, but company can pay it now. You can pay expense for future. You can pay expense now, which belongs to future, but you cannot record income now, which belongs to future. Did you understand that?
Yes.
Okay. So that if you understand, that's all for your constraint. Sorry, constraint, which is conservatism. So your constraint is finished. Your operating guidelines, which involve principles, assumptions, and constraint, right? That's all finished. So in principle, so we give the quick glance of what we have done. In your principle, what we study revenue recognitions principle, then we study full disclosure principle, then we study matching principles, right? We study 3 principles. Then we study 4 assumptions: business entity assumptions, time period assumptions, going concern assumptions, and one more,
monetary
units assumptions. Yes. And constraint, we study 2 constraint: materiality and conservatisms, right? So operating guideline finished. Topic 1 is finished. So anybody has any question? Topic 1. Any question? Topic 1. If no question, then we can have a break now. And after break, we will start our topic 2. Right? So we can have a break. I'll see you soon. Thank you. Now we start our next topic, which is double entry system. So in this topic, you will learn that how to record financial information in accounts, how company record the financial information in their accounts. That's what we going to study in this topic, right? Student, I need to ask you one thing about your schedule. Anyway, we will discuss at the end of this lecture. So we will have a look at how company prepare accounts, or how company record financial information in their accounts. So in order to understand these things, we have to prepare accounting cycle. What is accounting cycle? Accounting cycle, basically, it's a process that helps us to prepare financial records. So this accounting cycle has 5 steps. So these 5 steps help us to prepare financial accounts or financial statement, right? So in this accounting cycle, we start with the first step, which is source documents. Source documents. Second step, I will explain you all step one by one. Second step is a journal. Third is ledger. Then trial balance. And then we have final account. So that's, we have these steps. All right. So this is accounting cycle. Step 1, which is source document, journal, ledger, trial balance, and final account. So final account, another name of final account is a financial statement. We can also call it financial statement or financial report. Financial statement or final account or financial report. So let's start with the first one, which is a source documents. So what is source document? Source document is simply evidence. It's just evidence of any economic events. Whatever transaction, obviously monetary related transaction, if any kinds of transaction occur, that transaction require evidence. When any kinds of transaction occur, we need evidence for it. For example, company purchase assets, any kinds of assets. So purchase asset is your source documents. And then you're going to record this purchase assets in your accounts through ledger, journals, ledger, trial balance, and finally in accounts. Right? So source document is just simply a evidence of information. So let me write down here source documents, some examples of source documents, some random example. As I mentioned, source documents, whatever is happen inside the company, right? So for example, company purchased. So the first source document is, for example, purchase land.
Yeah.
Purchase land, for example, $10,000. Sold product by cash. Sold product by cash. For example, $2,000. 3, for example, paid rent. For example, borrowed money from bank, $7,000. Okay, so these are the source documents. That's the meaning of source documents. Anything happen inside the company and which has a economic value. So you can see all these things has a money value. Purchase land, sold product, paid rent, borrow from bank, receive interest, or purchase material. So this is all about your step 1, which is source documents. All right. Now let's move on to your step 2. So I'm going to write down your step 2 here. Step 2. Step 2 is a journal. Now, what is the meaning of journal? Another name of journal is a book of prime entry. We also call it book of prime entry. Now, what does it mean, book of prime entry? Book of prime entry means journal entry is an account, book means account, in which we record information very first time. Source documents. We haven't started recording information in our accounts. We start recording information in our accounts from step 2. All right. So journals teach us how to enter the information in the system, in the accounts, in the books, right? That is journals. So in order to understand journals, we have to follow some rules and regulations. If you want to apply these journals to enter all the source document into accounts, right? So we have some rules, or you can call it some principles, some rules or some principles. So you need to know these rules and principles in relation of journals, right? So in these rules, remember, we have assets, we have liability, we have equity, we have income and expense. You know that we have 5 elements. So always remember, if assets increase, assets debit, assets decrease, assets credit, liability increase, credit, liability decrease, debit. So we use the word debit and credit. All right. We use the word debit. DR stands for debit and CR stands for credit. CR stands for credit. Right. Equity increase, credit, equity decrease, debit. Right. Income always credit. Expense always debit. Remember, I said income. Income, gain, profit. That's called income. Expense, loss, cost, always credit. All right, but I'm writing only expense. So these are the basic rules you need to know before we start entering information in our journals. All right, using these source documents. All right. So once you understand these rules and regulation, now I'll show you some steps and then we start doing our journals. We start entering information. All right. So now we do some steps for our journals. Right. So step number 1, we have to follow these steps to prepare journals. Step number 1 is find source documents. Find source document, right? So here we find first source document. For example, if we look at this one, we find the first source document, which is purchase land 10,000, right? So we already have source document. Now, step number 2 is, after finding a source document, we will find which accounts affect. If you have a look, purchase land, which accounts affect in this purchase land? Which items, account means items, which items affect in this land? 2 items affect. Which 2 items? One is land. Remember, when I say item means item that comes under in this 5 category: assets, liability, equity, income, expense, nothing out of that. All right. So step 2 is find items or accounts affected. So you can see here 2 accounts affect. When you purchase land, your land affect. So you are buying. So your cash affect, cash and land. So 2 accounts are affected, or 2 items are affected. Sometimes 2, sometimes 3, but generally or most of the time 2, right? Step number 3, then find these items or accounts, increase or decrease. So for example, when you purchase land increase or decrease? Your land will increase, all right? Cash, when you purchase land, company cash increase or decrease? Company cash decrease. This is your step 3. This is step 2, and this is step 3, right? Increase or decrease. Now, step 4. Step 4 is convert this increase or decrease into debit, credit. Land increase, cash decrease. So you have to convert this increase, decrease into debit, credit. How can we convert this increase, decrease into credit, debit? We can use the rules. Convert using rules. Using rules. So land. So you have to find land is what? Land is assets, land is liability, land is equity, land is income, or land is expense. Tell me fast, what is land? Land is assets, liability, equity, income, expense. Tell me, what is land? Convert, increase. Yep.
I think land is assets.
Land is assets. So land increase. Land is asset, asset increase. So it will be debit. So land,
Yes.
debit. Land, debit. All right. Next is Cash. Cash is assets, liability, equity, income, expense. What is cash?
Expense.
Can you check? Did I write cash as an expense? In your expense, did I write cash, C-A-S-H, the word cash? No, cash is not expense. What is cash? Tell me, what is cash?
Equity.
Tell me quickly. That's supposed to your homework. You're supposed to know all these items. That's why I said that lecture one is important. Elements. Go to elements and check. What is cash? Liability. Why cash is liability? Go and check. Did I write the word cash as a liability? You have to find the word cash. If I say cash, you have to find the word cash. Find this word cash in your elements, where you can find. Quickly, you're taking too long. That was your homework.
Cash is assets.
Yes, cash is your assets. Remember, assets means current asset. Cash, account receivable, closing inventory, prepaid expense, right? All these are your assets. So cash is your asset, remember, all right? So now, cash is decrease. So it means assets decrease. So cash will be credit. All right. So that's your step 4. And now step 5, make an entry. You will make a journal entry. So what is journal entry? So journal entry is land account debit. You just write DR, don't need to write full. Land account debit, how much? 10,000. And cash account is credit, 10,000. So all this is your final answer. This is your answer. So this step 1, 2, 3, 4. You don't need to show me this step in your exam. You can use these 4 steps in your rough paper. You just need to show me the answer, which is step 5. But anyway, when you practice again and again, then you don't need to go step by step. Then you can make it fast. But again, you have to practice more. I will give you more exercises and more practice, and then you will be okay. So this is your answer. But remember one thing. When you make journal entry, always remember, always debit first. Always remember, debit is always top, then credit. If you, in your exam, if you write the answer, cash account credit, land account debit, I will give you cross. I'll give you wrong. All right. So always debit first, then credit. So debit first, then credit. Debit, credit, not credit, debit. All right. Remember this thing. This is your journal. That's it. So you have to do all the source documents. This is finished one by one. Now let me explain you second, and then 3, 4, 5, and 6 you will do by yourself. All right. So let me explain you second. Now listen me carefully. So it says that sold product by cash, $2,000. So find source document. So step 2 is your source document. All right. So we will make journal entry for this second one, second source document. Now find items or accounts affect. Can you tell me which 2 accounts or item affect? You sold product by cash. So means you sell product and customer give you cash. Which 2 accounts affect here, or 2 items affect here? Product and cash.
Product and cash.
Product and cash. Cash and product, but I don't call it product because we sold it. So I will call it sales, or you can call it revenue. All right. So instead of saying product, I will call it sales. Sales means obviously you sell product, you sell service. Revenue. Revenue means money that you earn by selling something. So selling product, right? So these 2 accounts affect. Step 2, finished. Now step 3, find these items, which is this and this, increase or decrease. So cash, increase or decrease. Cash increase or decrease?
I think it's decrease.
It's increase because you sell product. And your sales increase or decrease? Not product, sales. Sales also increase. All right. Now convert this increase decrease into debit credit using rules. Now cash, you have to find cash is what? Cash is assets, liability, equity, income, expense. What is cash?
Add assets.
Cash asset. So cash increase. So one thing confirm, cash will be debit because cash is assets, assets increase. So that's why debit. All right. Now sales. What is sales? Assets, liability, equity, income, expense.
Sell in liability.
Are you sure? Go and check your
Sell in
liability.
income.
Yes,
Sell
what
in
is?
income. Sell in income.
Yes, sales is income, not liability. Go and check, right? Your accounts. So you have to remember all the elements, all right? Now sales is income, and income always credit. So that's why sales is credit. Now make a journal entry. So journal entry is cash accounts debit, because debit always first, and sales or revenue accounts credit, which is always remember amounts always equal. Amount is $2,000 and 2,000. That's all. That's your number 2. Is that okay? Is it fine?
Yes.
Okay, if yes, anybody has any question? No questions, then move on to, you do it 3, 4, 5, 6 right now. Finish all, one by one. When you finish all, then we will check the answer. Start with 3, which is paid rent. Paid rent, $100. So let's have a look at the answer. Someone already sent me. Some are right, some are wrong. So let's have a look at number 3. Number 3 is rent. Paid rent 100. So paid rent is rent expense. Make sure you write expense, not otherwise we're not going to understand is it income or what. Rent expense accounts debit and cash accounts credit. 100, 100. Number 4, borrowed money. So borrowed money from bank, cash accounts debit and bank loan. All right, bank loan accounts credit. 7,000 and 7,000. Number 5, receive interest. So what is number 5? Okay, so number 5 was receive interest. Tell me number 5. Anybody? Tell me quickly, receive interest. Anybody who's done this one? Nobody receive interest? So receive interest, which two accounts affect? Cash and interest income. All right. So cash increase or decrease. When you receive cash, cash increase. So cash debit. Receive increase income, interest increasing. So cash accounts debit because you receive cash. I don't remember how much was the amount. How much? I don't remember. And
$150.
sorry?
$150.
150. Okay. So cash account debit, 150. And interest received or interest income. Interest income accounts credit, 150. Why it's credit? Because interest income, and income always credit. That was number 5. Is that okay, number 5?
Yes.
What is number 6? Journal entry, the source document.
I think material is increased.
No, I mean, what is the source document? Tell me the source document. I don't remember the source document.
Purchase material.
Purchase material. 1,500 by cash.
Yes.
Okay. So purchase material. So what is debit? What is credit? Make journal entry. Tell me.
Debit is material and cash is credit.
I write out purchase and material.
Yes, purchase material also okay. Purchase material accounts, debit, and cash accounts, credit. That's all. That's all your journal entry. Now, what I'm going to do, of course, you need to practice a lot for the journal entry. So that's why I am giving you a homework. All right, so you have a 10 or 12 journal entries. It is your homework for journal entry. So make sure you download and you save in your system. And I'll show you the file. The file, I just sent it to you. Here. That's your journal entry. You have 12 source documents. So you need to make journal entry from this source document. Borrowed money from ACB, 5,000. Issued or sold share to investor, 10,000. Purchased furniture, 3,000. Paid electricity bill, 100. Received dividend, 250. Sold building, 5,000. Borrowed money returned back to ACB, 5,000. Cash received from account receivable, 2050. Purchased raw material, 1,200 by cash. Paid dividend to shareholders, 65. Cash paid to accounts payable, 200. And sold product to customer by cash, 400. So this is your homework. So you do this homework and next week I will check your homework, all right? And one thing I need to explain you here about here. Sold share. Which two accounts affected? When you sold share, what do you receive? You receive cash increase, right? Second thing, most of students, they write here sales because they think sold. Yes, it's a selling share, but it's not a sales. So this is your share capital, and share capital is your equity. So when you sell share to raise money, your share capital increase, not decrease. Make sure you know that. All right. Share capital means the money. Share means number of shares, the number of shares that you sell in a market. So when your number of shares, you sell more and more share, you receive more and more share capital and you invest this capital. You sell less shares, you have a less number of shares. Less share capital. So when you sell share, your share capital increase, not decrease. Right? So remember that. And share capital, of course, share capital is your equity. When equity increase, equity will be credit. Right? And cash debit because cash increase. So cash debit, share capital credit, 10,000, 10,000. That's your number 2. Is that okay? Anybody has any question? Any question? Yes or no?
Can you write out the circle of the accounting again, please?
Yes. So we finish this source document, we finish this journals, but we don't move to step 3 until you become perfect in your journal. All right. So this lecture, we stop journal. Next lecture, I think next whole lecture, we have to spend on journals, because step by step, I'm giving you more and more difficult journal entries. So you will start making it. So that is your accounting cycle.
Teacher, also, I have the question about the conservatism.
Conservatism.
Yes. Yes, if we have the future income and we have
Future income is
like additional money, how could we know the risk of it?
How we know additional money?
What
do you mean?
risk?
I did not understand what is your question. Can you explain again?
If in the future and we meet the risk, we have additional money from the self expense, how could we know that in the do not sell in the future income?
No, it's not about sell. It means something you're going to sell in future, not now, maybe.
Yes.
So you cannot record as an income right now because you haven't sold it. That's what it means, and that makes sense. In also real life, for example, let me give you one example. For example, you have a shop. In shop, one customer comes to your shop to buy something, but that customer is not buying anything. That customer grab one product and start looking at that product. For example, customer is looking at pen. So when customer is looking at pen, can you write down in your account sales $10? Can you do that?
No.
No. Why? Because customer will buy in future, because now customer is simply looking. Customer will buy in future. Something customer will buy in future, you cannot record as an income right now. You have to wait to things happen. Things happen when customer comes to you, ask the price, ask you to pay, give money, exchange of product and service. Now it's become income. Something you haven't sold, you cannot record as an income. That's what it means. Simple. It's very simple. This is simple and obvious. All right. So that's its conservatism. Conservatism is very obvious. Something you will earn in future, you cannot record right now as an income, but something you pay in future, something is your future. Can you pay now? Yes. That's what it means. Future income is not present income, but future expense is present expense. Something gonna happen in future, which is expense. Can you pay now? Yes. But income, something gonna happen in future as an income. Can you record now? No. So that's why future income is not present income, but future expense is present expense. That's what it means. And
yes,
that makes sense. Right? Is that okay? Is it clear?
Yes, easy. Thank you.
Okay. Any other question? Anybody? Any other question? If no question, then we stop here. So please do your homework. So next week, I will ask question by calling your name, and then you have to give me answer. All right. So we stop here. I'll see you next week, Friday. Thank you. Bye-bye.
Thank you.
Bye-bye.